Hello and welcome to On the Couch with Steve. This is a podcast where we help you navigate the world of buying and selling real estate. I'm Steve Athanates. I'm the owner of NG Real Estate here in Ipswich. Now, today we're talking with Logan Stanford from Stanford Financial. Logan's here and he's going to talk to us about a very topical subject, which is mortgage deposits and capacity. So welcome along, Logan. Thank you so much for your time.
Thanks, Steve. Exciting to be here.
No, thank you, mate. I know you're a very, very busy man. Mate, we're going to jump straight into it. I'm going to ask you some basic questions. There's, obviously people are going to be at different levels of knowledge. So how much deposit do I need if I want to borrow to buy a house?
Great question. So with deposit, the golden number is 20%. Now it's 20% of the purchase price. On top of that, you have to account for things like stamp duty, government fees and charges, setup fees, all that kind of stuff. But the golden number is 20% plus a little bit. There is options available from as low as 2% with some government-backed schemes, such as the single parenting scheme. So with the government guarantees, the other 18% necessary to avoid lender's mortgage insurance. And for first home buyers, there's a 5% deposit scheme as well. Now there's, depending on the suburb that you're buying in, there's different caps for how much can be the maximum purchase price. But generally speaking, with as little as 2% deposit, there's some schemes out there to support you. Now, there are lenders that offer all kinds of different creative solutions. So being a broker, we have access to over 40 different lenders. And what that means is, all your majors, generally speaking, they want about 5% deposit as a minimum standard, just every day, John and Mary buying a house, 5% deposit. Then your majors are generally pretty happy with that. But the key factor on that is lender's mortgage insurance. So lender's mortgage insurance, some people think it insures them, but what it means is with just a 5% deposit, the lender generally will charge you a premium, and it's a fee that gets financed on top of the loan, and it covers the bank in the term in the instance that you, for whatever reason, need to sell your home, or the lender needs to repossess and sell your home and doesn't get the amount that you're owing.
So if there's a shortfall, there's an insurance for the lender.
Exactly. It covers the lender. Now, a lot of people think lender's mortgage insurance, it covers me if I lose my job or if I, can't make my payments, whatever it is. It does not. It covers the lender. Yeah. So, but the key number to avoid that lender's mortgage insurance, because it can be quite expensive, can be tens of thousands of dollars, is if you get that 20% deposit, you're pretty much covered. There are lenders that go up to 90%. There's a lot of really creative things that can be done. And there are lenders who allow a personal loan to get you below. So in some instances, it may be cheaper to get a personal loan, get below the 20%, then pay the premium.
I didn't know that. Yep. So we'll delve a little bit deeper into that. So on the same sort of line, how is my borrowing capacity determined?
Yeah. Okay. So capacity is an interesting one, because if you don't have capacity, you can't get the loan. It's as simple as that. Whereas with deposit, like we were speaking about before, you can get personal loans, you can get gifts, you can get guarantors, you can get government schemes. There's all kinds of different things you can get to cover that hurdle. But with capacity, generally speaking, you think about it as money in versus money out. So if you're earning a salary, the lender will then go, right, what are your debts that come out of it? So you're getting, X amount per fortnight. They then subtract all of your loan repayments. So it might be a car loan, a personal loan, a credit card. Now, important thing on credit cards is they go off the limit, not the balance. So you might have what we see a lot of is a $6,000, Latitude credit card or something like that. But I just bought a fridge for $1,000, but I just got the max limit. Now the lender actually goes off the $6,000 limit.
Because you can spend it
Exactly. And so they take out all of those repayments. You then have an amount left. They take out your living expenses. Now there is a minimum living expense amount, so you might only spend. You might be really budget savvy. You might be really good at shopping savings and things like that. But the lender does have a minimum threshold for expenses.
Let's talk about that minimum threshold. So, of your 100% of your income, the bank doesn't want to see you spend more than what percentage?
Yeah, good question. So there's then the debt to income ratio as well. So there is, which most lenders are at about 6 times your income is really what they don't want to see you borrowing over. So there are lenders that go up to 7 and 8 when it comes to investment properties, but most lenders don't want to see you borrowing 6 times your annual total income, which is sort of an easy way to just what's my quick max borrowing. If you don't want to do the manual version of, okay, I get this much after tax and then take out all my debts, take out all my living expenses, leaves this much to make a loan repayment every month. If you just go, what's my income times 6, that sort of gives you a really round average number for what you may be looking at from a borrowing capacity perspective.
Okay, so let's take an example. We've got, say, someone here in Ipswich. Okay, median house price is 550,000-ish.
Yep.
So how much money would I need to earn as a minimum if I wanted, say, to borrow a property for, say, 550? I'm going to work on, say, I've got a 10% deposit. So whether I save that or I got a gift or whatever,
Yep.
I've got roughly a 10% deposit. Okay, how much is my base income between me and a partner, or individually?
Yeah, good question. So for a standard couple with no sort of other debts, really, no kids, double income, no kids, a combined income of about 80 to 90,000 will probably do the job there. If they have a credit card, then a little bit extra, things like that. Now, it is important to remember there are lenders as well who shade things down or take an amount out of overtime and things like that. So 85 to 90,000 as your regular income, or if you get regular overtime, that's great. But making sure that we go to a lender who takes 100% of that overtime and allowances and things like that should be good for a 500K borrow on a 550 purchase price.
So even to, let's say we've got a standard couple, they might only be earning, say, $45,000 to $50,000 each, but in theory, if they don't have any other major debts, they should be able to afford to purchase a property in that sort of 5 to 550 range if they have roughly a 10% deposit.
Yeah, definitely, Steve. So what you'd actually probably find, and I'm sure you know, is it'd probably be cheaper for them to purchase a property like that than rent one. The repayments on a property like that would be far cheaper. You'd be looking at $650 a week for a property like that out here, or $600 a week. The repayments on something like that is far lower, even with rates where they are today.
Okay, so that's a good point. And I like the fact that we're making that sort of establishing the difference between rent and a repayment. So on say a $500,000 loan over assuming a 25 to 30 year period, which is the normal tenure for a loan, what sort of repayments would you be looking at just generally?
Yeah, good question. So for principal and interest, and I'll touch on the difference between that and interest only in a minute, but for a principal and interest loan around that number, you're probably looking at that 6 to 650. But from the cash flow perspective, the key difference there is you're paying off your out of that 650, about 400 of it is going back into your pocket. Essentially, you're paying down your home. Whereas if you're renting for 650 a week, that's obviously going down and paying down your landlord's property, and that's all great. That makes the economy go round. But that means that in the years to come, you can go and use that equity that you've built up by paying 400 or 450 into your house every week. You're paying it down by about that much. You can then draw that equity to do renovations, put on solar panels, buy another property, and build wealth. Home ownership is obviously the greatest way to build wealth in this country, and by getting out of paying that $650 in rent and contributing to paying down your home instead is a massive way to do that.
That's awesome, mate. Look, I think everyone will find that particularly interesting, and it's nice to know that a big chunk of that repayment goes towards building equity.
Yep.
And obviously future wealth.
Yeah.
So I think that's really important. Now, we just talked about that in that same example, a 10% deposit.
Yep.
Now, you said 20% is the golden number because if we have less than 20%, we have to pay lender's mortgage insurance. So on the same sort of scenario, we've only got a 10% deposit. Just roughly, again, how much sort of mortgage insurance, what would be the charge if we only had a 10% deposit on a $550,000 buy?
Yeah, so about 10 grand roughly. Obviously, I'm not in front of our computers right now, but around 10 grand in lender's mortgage insurance, but that gets capitalized into the loan. So what that means is your base loan to value ratio is 90%. You're borrowing 90% of the property's value, but the capitalized on the LMI might be 93 or 94. So the lender will lend you the money for that lender's mortgage insurance as well. It's not like generally you have to come up with another 10 grand, they can lend that to. The problem is when you're at the 5%, some lenders will capitalize up to 99%, but most lenders want to see up to 95% capitalized LMI, which means the max borrow is 95, and then you've got to pay your own LMI on top of that. But if you've got a 10% beauty, you can just borrow the extra LMI on top of that.
Okay, again, great to know. Now, in a difficult situation, Logan, some people at different stages of their life have got themselves into some sort of financial trouble, and they may have some history issues where maybe they were late on a payment or something had gone wrong. How do you get over those sorts of issues? Is it possible to get over credit issues?
Yeah, definitely. So you'd be surprised at some of the banks that accept things like defaults. Major banks, one of the big five even, are fine with a default up to $1,000 on your credit file. It does not buy you at all. And then there are lenders who don't even do comprehensive credit reporting, which means they may not see the default, they may not see the late payments, they don't want to see it. They'll just look at 6 months conduct on your bank statements, and if you're making the payments, then it's fine. A couple of days late does not go on your credit report. Once you're getting up to a month late and you're missing full months of payments, that's when it starts to build up. But there are lenders who will just look at the score, not the actual history of the payment. And so some of those solution-based lenders where they may be a slightly higher interest rate, but you pay the ferry keeper, you get to the other side, and then you can refinance in 6 or 12 months once you've had some good conduct there. But some prior, life happens, and some prior issues on your credit file, absolutely. If you cover off on the deposit and the capacity side of things, not an issue at all.
Okay, so great to know there is some forgiveness there if it's a fairly minor transgression, and then if you've obviously rectified it.
Yeah. So on that though, we've got people who are bankrupt one day, full bankruptcy, 1 day discharge, and we can get a home loan from because they've paid their debt, or they've cleared their debt, they've waited their period, and the banks are happy to give them another crack.
Okay, guys, thanks so much for tuning in to On the Couch with Steve. Obviously, we're here with Logan Stanford from Stanford Financial. Logan, all the information that you've just provided us has been so invaluable, and I'm sure all the people out there have loved what you've talked about. It's very, very important. Now, obviously, to our viewers and our listeners, if you have any questions about the topic that we've discussed today, obviously, we'd love you to jump on our socials and ask any questions that you'd like. And most importantly, we'd like you to stay tuned for more information and sessions with Steve on the Couch. We'll see you soon.